Now classification of accounts as per modern approach. In this following chart we will study about different types of accounts and they are summarized into the different categories. So all the accounts are divided into 5 types here as assets, liabilities, capital, revenue and gains, expenses and losses. So what is assets? Property owned by the business. There could be machinery, building, goodwill, furniture, etc. All these are assets account. Then there is liabilities, amount payable by the business, creditors account, bank overdraft account, bank loan account, outstanding expenses means amount of expenses yet to be paid account. Then there is capital account, amount invested in the business. So here there is Aditya's capital account, Girish's capital account, Messrs Harilal traders account, Messrs Sharma traders account, means name of the individual businessman will also be given to you here. Then there is revenues and gains account. Here there is mostly the income and the benefit of the business. So here commission received, dividend received, rent received, interest received, like discount we have received. All this will come in revenue and gains. Then there are expenses and losses like wages account, when business pays wages, audit fees, loss by fire, printing and stationery account. All these are expenses and losses. So let's see further what we are going to do here. So 2 important rules are given to you. First, for recording changes in assets, expenses and losses. What happens if such changes will come here? If there is increase in the asset, we have to write in the debit side. So increase in the asset is debited and decrease in the asset is credited. Second is increase in expenses, losses is debited and a decrease in expenses or losses is credited. Then for recording changes in liabilities and capital or revenues or gains, if there is increase in liabilities, that has to be credited, and decrease in liabilities is debited. Increase in capital is credited and a reduction in the value of capital is debited. Increase in revenue or gains means increase in income or benefit, that has to be credited right on the credit side, and a decrease in revenue or gains is debited. Now in the previous part we have studied about golden rules of accounts of 3 type of account: personal, real and nominal. If you are not comfortable with that part, you can take this modern approach also to classify the accounts or to do recording of the various business transactions. Any of the one is useful for solving different accounting transactions. So let's see one example here. So Sanjay commenced business with cash rupees 70,000. So what happened here? First, cash comes in business. Then second effect, proprietor is a giver of the capital. Accounts involved here, in the first one there is cash account. Second, we have to find there is capital account. Categories: cash will come under assets account. Capital is a part of capital account only as per the modern approach. So rules applied here. For the asset one, what were the rules for asset? Increase in asset is debited and decrease in asset is credited. So here cash came into your business, so assets increased. So rules applied here will be first increase in asset. And for capital, the rules for capital were increase in capital is credited and decrease is debited. So here when you give cash to your business, your capital will increase. So increase in capital has been applied here. Accounts to be debited, so cash account will go to debit side and capital will go to the credit side. Second is rent paid cash 5,000 to Amol. Now here rent is an expenses. Now you have paid the cash, so cash goes out. So 2 accounts involved is rent account and cash account. Rent is a type of expense, so expense account. Cash is a type of asset, so asset account. Now what were the rules for expenses? The rules for expenses were increase in expenses is debited and decrease is credited. So here there has been increase, so it will go to the debit side. so rent will go to the debit side. And rules for the assets were increase in asset is debited and decrease in asset is credited. Now here cash goes out from a business means your cash will get reduced, so it will go to the credit side, so cash account will be here. And third is withdrew cash from bank 10,000 rupees 10,000 for office use. So here cash comes in, cash will be in your hand now from the bank, and who gave you that cash? Bank is the giver. Now accounts involved here is cash account and second is bank account. Cash is an asset, so asset account. Bank is also an asset, so asset account here. Then rules applied for asset here is increase in asset. You got cash, so there will be increase in the value of your cash, so increase in asset. Second, asset got reduced from bank, so decrease in asset. So increase in asset will be debited, means cash will go to debit side, and decrease will go to the credit side, that is bank account. Fourth, paid wife's mobile bill rupees 4,200. Now whatever expenses you pay for your personal use, that is termed as drawings here. So drawings is the receiver of benefit. Second will be like cash goes out from a business. So your first will be drawings account and second will be cash account. Drawings is a part of capital account, so capital account. Cash is an asset, so asset account. The rule for capital were increase in capital is credited and decrease is debited. So here there has been decrease in capital account. When you withdraw amount from your capital, what will happen? Your capital will get reduced. So decrease in capital will be applied here. So accounts to be debited is drawings account, and decrease in asset here on the credit side we will write cash account. The last one is purchase goods from Sunil 13,000. Now you have purchased goods, but there is no mention that whether you have paid the amount or not. It means it is credit transaction. In the credit transaction, name of the person will come, not cash. So what happened here? First, purchase is an expense. Second, Sunil is giver. So accounts involved will be purchase account and Sunil account. Purchase is an expense, so expense account. Sunil's account here is liability. Why liability? Because you are supposed to pay amount to Sunil. You as a business have purchased goods from Sunil, so you have to pay back to Sunil in future. Hence it is liability account here. So expenses, increase in expense, your expenditure has increased, yes, so it will go to the debit side. So purchase account will come here on the debit side, and liability also got increased here because you are supposed to pay amount to Sunil. So Sunil account will come on the credit side. This is the way you can solve the accounting entries with modern approach.